I started in the market over 40 years ago. The market reacted to these same things exactly the same way, and it did not work out so well. It's kind of appropriate that we have an AI circle tonight.
Yeah.
Most of everybody knows, of course, that artificial intelligence, in our particular case, our variant of that is machine learning. There is a difference between AI and machine learning. The differences are nominal, but just to be sure, AI is, again, a very loosely used term. That being said, the name of our thing twice a month, AI Circle, is oftentimes me opining on the market at some level, and then also reminding users that are on the platform of how AI and our machine learning component works into your existing portfolios. Today, obviously, the market was up large. It was down 250 on the Dow, ended up 700 and something on the Dow, 1,000-point swing. We have a few things going on that are kind of interesting. For the first time since literally February, the S&P 500 closed above its 200-day moving average. Now, that is a significant thing, and we do look at that. That, coupled with other things devised around our machine learning component, means that there is a potential for a buy signal, folks, in the few coming days. Some of this information coming out of the algorithmic side is pretty bullish, actually, especially given over the last 1 month since our last AI circle. However, the AI and machine learning component still has a lot of red flags. So I will be interested in the coming days if any new information, like our credit card data information, comes out this Friday, could also give a clue as to whether or not we get a short-term buy signal in the S&P 500. And just so everybody knows, that is it is a major event. That means that our company and all of your portfolios could be looking at going into the market late in December. We have generally been out of the market most of the year. However, during this year, as everybody knows, the S&P was down 26% at one point. The Dow Jones was down about the same. However, year to date now, and the NASDAQ was down over 30%. However, given what's happened today, the Dow Jones is down no more than maybe 4.5% on the year. And although that is a very corruptible index, the S&P, which is not, gained another 2%. It's only down 14% of the year. The main thing that this signal could mean, if we get it, is that there's a lot of other stocks that are tied to it that could develop long signals as a result of the major markets offering a buy signal. And that means we might, in the very coming days, by the end of the week or next, there is a possibility that we move and go risk on and move back into the markets with your money. So that is what occurred today, partly because of the price movement and partly because of the change in the interest rate environment. Let's look a little closer at the interest rate environment. I think that needs talking to. As you know, over the course of AI circles all year, I have focused on look at the interest rate market and looking at the foreign exchange markets. All year long, the dollar has been getting stronger and the interest rates have been going higher and the stock market has been going lower. Generally, the bond market is the thing that leads the way for all things, which means foreign exchange ultimately will look at the bond market. The stock market ultimately will look at the bond market for direction. Well, the bond market has not really given any signal that interest rates are changing. And by the way, that includes what Jerome Powell said today, which was that he is going to raise rates, but he may only go a half a point instead of 3/4. The stock market looks at that with glee, thinking that, oh my gosh, maybe the Fed does have inflation under control, and we're going to get a head start on going long the market and getting into all these beat up stocks. And those stocks today actually were NASDAQ stocks. If you look at Apple, for example, Amazon, and many other stocks today, they were up. Microsoft, they were all up between 4 and 6% on the day. However, these are stocks that were down 40% in the case of Amazon during the year. It was down 40. So now it's down 34%. I don't know if I can take much solace in that. But that being said, the rally is significant today, and more significant than the 1,000-point rally we had a couple of weeks back. And the reason is because now the interest rate environment may be in a pendulum where it's swinging from one end to another. So all eyes now are on the component that matters most and why we're here, which is the machine learning artificial intelligence component, which looks at all this fundamental data and decides if other information that's technically driven should be adhered to or be overridden by the machine learning component. I will opine further to say that I feel it's 50-50 that we get into the market or not. I am looking at the data with very, very keen eyes at this point. Let's go a little further down. So let's look at the interest rate market. Now, today, of course, the Fed signaled that interest rates may be ratcheted up less aggressively. Well, over the last month, if you look at interest rates, they have come down on, for example, the 10-year note from around 420 to 380. Well, that's about 10%. In other words, it's 10% better. So we've had a 10% rally in the bonds because of this, in the 10-year bond, because of the Fed signaling maybe they will have control. When I remember again that I started in the market over 40 years ago, the market reacted to these same things exactly the same way. It's very well etched in my own mind, and it did not work out so well. As I pointed out many times before, inflation is sticky. It just doesn't go away because a Fed chairman whims it away or talks with his open mouth committee to be able to say that interest rates may need to be raised less aggressively, as that being a good thing, as if a half a point is going to make a difference. He thinks he's fine-tuning things when he's really changing channels. So we're going to find out if that's true. Again, whether we like it or not, we must follow the math. And right now, the math generally still speaks to a lower market, especially early next year. But that doesn't mean that there might be something to be made over the coming weeks towards Christmas and end of year. I have noticed personally that things happen this year generally, literally on the dates at the end of every quarter. I mean, we put in a low at the end of September. We put in another low at the end of June, marking the second and third quarters. And we put on a rally on literally the very first day of October of the fourth quarter. And so I wouldn't be shocked to see the market advance a little further to kind of eke out maybe a gain in the Dow for the year and smaller losses for the S&P and NASDAQ by year end, which is only a month away, folks. So today was significant. No, let me go one further on the foreign exchange. Now, the foreign exchange markets, we've also keep a close eye on too, and those are components of our machine learning. But I think it should be noticed that even though the foreign exchange markets have corrected, in other words, the dollar has become a bit weaker over the last month or so, the reason for it is, again, Fed signaling. If the Fed signaling turns out not to be working, you will see the dollar resume its rally, interest rates resume their increases, and the stock market, of course, will be left holding the bag and be ready for significant losses in the beginning of next year. But that we will not know until next year. In the meantime, there may be something to do here. Those foreign exchange markets are reacting to interest rates, and they have come down 10% and more, made 5-6% in the euro dollar, and the British pound is literally gone from 104 to 120. So we're looking at a large increase there, almost 16%. And we're also seeing a decline, the first decline in the yen in a long time. In the dollar versus the yen. So when I see that, I feel it's interest rate driven. It is a component of our AI. And so again, it is changing some of the dynamics of how we generate signals. So we're going to look into that and see what that beholds over the next few days.